Hey, welcome back to the What the Wealthy Do podcast, where we break down the money moves that the wealthy make and show you how you can apply those same strategies on your own personal wealth building journey. I am your host, Stephanie Dorsey. I am the CEO and co-founder of Margins Capital. And at Margins Capital, we're an investment firm that's focused on providing women and people of color access to an institutional quality portfolio of alternative investments. Now, if you've been following along with our alternative investment series, you know we've covered private equity, venture capital, commercial real estate, and hedge funds. And so today we're going to be diving into two asset classes that might sound very boring, but are absolute wealth generators for the ultra wealthy, especially with the state of the world that we're in right now. And so those are infrastructure and natural resources. I'm talking about the stuff that literally keeps the world running. We're talking about roads, bridges, power plants, water systems, oil and gas, precious metals, timber. These are the unsexy investments that quietly print money while you sleep. And here's the kicker. While everyone's chasing the next hot tech stock or AI stock, frankly, the wealthy are over here owning the pipelines, the toll roads, and the copper mines because they know trends come and go, but people will always need water, electricity, and roads. So before we get into it, you know the drill. This podcast provides financial education and not financial advice. I love this stuff. I mean, we kind of landed in this space, Margins Capital did, so I'll be talking a little bit about some of the things that we're investing in, but it was really important to me just to dive deeper into these different alternative asset classes to see like, where are people really making money? And if you think about Rockefeller, he was an oil guy. He did oil and gas, and then you got Carnegie, who had the trains. Again, these are titans of industry and they're the foundation. I mean, well, obviously it made sense for them to make a lot of money in these investments back in the day because, you know, we didn't have anything like that. But just think about how much money they made by investing in these type of assets. So let's start first. We're going to focus on infrastructure investments. And so what are they? They're basically the physical systems and structures that society needs to function. So you think about transportation, toll roads, bridges, tunnels, airports, seaports, railways, utilities like water treatment plants, sewage systems, electrical grids, gas pipelines, energy. So think about power plants, renewable energy farms like solar and wind or battery. We'll talk about that, in transmission lines. Communication. So those are your cell towers, your fiber optic networks, and your data centers. So they're also your social infrastructure, like your schools and your hospitals and your public housing. And so the wealthy love infrastructure because it's essential. Like people need it, businesses need it, governments need it, and it's not going away. So most infrastructure investments come with something beautiful, which is predictable long-term cash flow. And so if you think about it, if you own a toll road, cars are going to drive on it every day. If you own a cell tower, telecom companies are going to pay you rent every month. And if you own a water utility, people literally can't live without paying you. They have to have water, at least in America, right? And so that's the power of infrastructure. It's a monopoly on necessity. And Margins has made investments in the utilities and energy sectors because when a company creates a solution in this space, it's the value that they're going to create is basically like to the moon. And so we've invested in a private equity fund that invests in utilities, and we invested in a company called Form Energy, which is it's a renewable energy company that they're using 100-hour batteries to help supplement our energy systems, our utility grids that are based on fuel, frankly. And so I'm proud to say that Google just signed a $1 billion contract with Form Energy to help power its data centers. So infrastructure investments make their money in a number of ways. One, user fees. right? So if you own a toll road, bridge, airport, you collect fees from everyone who uses it. Traffic might go up and down, but over the long term, people got to get from point A to point B and they're going to pay. Also through long-term contracts. I mean, many infrastructure assets operate under government contracts or regulated agreements. For example, a water utility company might have a 30-year contract with a city. That means guaranteed revenue for decades. Right? Also, inflation protection. A lot of infrastructure contracts include inflation adjustments. So when the cost of living goes up, so do the fees that are negotiated in a contract, and your returns keep pace with inflation, and sometimes it even beats it. And as cities grow and populations expand, the demand for infrastructure increases. And so that asset that you bought 10 years ago, it might be worth more now because more people need it. The wealthy see infrastructure as the ultimate set it and forget it investment. You're not checking stock prices every day. You're not checking the valuations every day. You are collecting checks while the world literally runs on what you own. So that's infrastructure. What about natural resources? Natural resources are the raw materials that come from the earth. So we're talking energy, oil, natural gas, coal. We're talking metals, gold, silver, copper, lithium, rare earth elements, agriculture, so farmland, timber land, water rights, renewables, solar, wind, geothermal, and these are the building blocks of modern life. I mean, your iPhone, full of rare minerals, your electric car, powered by lithium batteries, your house, built with timber, concrete, and copper wiring. The wealthy understand that as the world population grows and technology advances, demand for natural resources will only increase. And unlike a tech company that can be disrupted overnight, you can't replace copper that easily. So natural resources usually make money in a few ways. So there's commodity price appreciation. So when demand for oil and gold or lithium goes up, so does the price. And if you own the mine, the well, or the timber you own or the land that you own, you win. Also, production and extraction. If you invest in an oil field or a copper mine, you earn revenue every time they extract and sell those resources. Royalties and leases. I mean, some investors don't own the mine, they own the rights to the land. And so they lease it to extraction companies and collect royalties on production. It's like being a landlord, but for the earth. And that is exactly what happens in the oil and gas sector. So as certain resources become harder to find, like rare earth minerals or clean water, the ones who control those assets can charge a premium. So here's the thing, the wealthy know that tech will change and economies will cycle, but people will always need energy, food, and materials. That's why they allocate to natural resources as a hedge against uncertainty. So let me break down why these two asset classes show up in almost every ultra high net worth portfolio. One, steady cash flow. These investments produce income, often for decades. The wealthy love passive, predictable income streams. Also, they're a hedge against inflation. So as inflation goes up, so do the fees, tolls, and commodity prices tied to these assets. Their purchasing power is protected.
Hey, it's Stephanie. If you've been listening to this podcast for a while, you know I talk a lot about how the wealthy think about money differently. And one of the biggest differences is how they approach taxes. Most high earners wait until April, file their taxes, and hope for the best. Wealthy people, they plan the October before. They design their income, assets, and giving around the tax code. And the gap between those two different approaches, tens of thousands or hundreds of thousands of dollars every year. That's why I created the High Earner Tax Playbook. It's a course that breaks down the exact strategies wealthy people use to legally pay less, from maxing corporate benefits the right way to side hustle or business deductions, donor advised funds, tax loss harvesting, and advanced strategies like QSBS for investors and mega backdoor Roth. This is not tax advice. This is tax education. So you can walk into your CPA meeting informed, confident, and strategic. If you are tired of overpaying out of ignorance, check it out. Link is in the show notes below. Now, let's get back to the show.
There's also a low correlation to the stock market. Infrastructure and natural resources don't move in lockstep with the S&P 500. When stocks crash, people still need water, electricity, and roads. And these are multi-decade plays. You're not flipping them in a year, you're holding them and letting them compound over time. And these aren't luxury goods. These are absolute necessities. So even in a recession, people will need power, cities need bridges, manufacturers need copper. The wealthy see these as defensive investments, low drama, high certainty, long-term wealth. And if you are paying attention and you're seeing what's happening in Cuba, and you see just how life or death some of these investments can be. So I'm sure you're thinking like, girl, I don't have $50 million to buy a toll road. So how do I get in? And it's fair. There are ways for you to invest, right? So you can invest in funds that invest in these type of investments. You can also invest in exchange traded funds on the stock market. So you can invest in infrastructure funds that own portfolios of infrastructure assets, or you can invest in exchange traded funds like Global X is a U.S. infrastructure development ETF, or Brookfield Infrastructure Partners. So master limited partnerships are publicly traded partnerships that own pipelines, storage facilities, and energy infrastructure. And they pay out most their income as distributions, but be careful. The tax treatment is a bit tricky, so make sure you talk to a CPA on that. There are certain types of real estate investment trusts, REITs, that have infrastructure focus, and some REITs specialize in cell towers and data centers or energy infrastructure. And you can buy shares just like stocks. So there are natural resource funds and commodities ETFs that invest in mining companies, oil producers, and agricultural land. I mean, you can also buy commodity ETFs tied to gold and silver or oil prices on the stock exchange. And then there are crowdfunding platforms that allow smaller investors pool money to invest in infrastructure projects or farmland, like sites like AcreTrader or Yield Street. We are not recommending these sites, but I'm just sharing that these platforms do exist. And then in terms of direct investment, an accredited investor, you earn as an individual $200,000 a year, as a married couple $300,000 a year for the previous 2 years, or have a net worth of $1 million excluding your primary residence, or have certain financial certifications also will allow you to bypass these criteria. Then you can make direct investments in funds like Margins, as well as, or whenever Margins has a fund, and other funds that invest in infrastructure or natural resources. The key is to start learning about these assets, learning how these assets work, and understanding the risks before you jump in. And so that's what I'm always going to preach to you. I want you to start to think about this and think about what role, if any, this can play in your portfolio, because you want to know before you make the decision. And so speaking of that, I want you to be aware of certain risks associated with these type of investments. The first is an illiquidity risk. Your money is going to be locked up for years, and you can't just sell tomorrow if you need cash. And then there are regulatory risks. For instance, infrastructure projects are often subject to government regulations. A new law or policy can impact profitability. And then there's commodity price volatility, like oil, copper, and gold prices can swing pretty aggressively. So if you're invested in natural resources, you have to have the stomach for volatility. Right now, gold is going off, but it doesn't always do that. So yeah, there are also high capital requirements associated with these type of investments. So direct infrastructure investments often require big checks, and so be thoughtful about that. We talked about illiquidity, but to double click on that, they come with long time horizons, 10, 20, 30 years time horizon. So if you're looking for a faster turnaround, that could be really difficult, because these are not assets that you get to flip. So you have to be thoughtful about how you invest in utilities. So we invested in a late stage venture capital investment in Form Energy to mitigate that time horizon crunch. Here's what I want you to take away from today. These asset classes are not flashy, but they're essential, predictable, and resilient, and the ultra wealthy love them, right? And so while people might be chasing crypto or a flashier alternative investment, this is, people talked about when the railroads, right? So when the U.S. became what it was when we started building the Transcontinental Railroad, and actually Carnegie did steal, but JP Morgan got rich on railroads too. But what happened was you could get rich on the railroads, or the guy who sold the shovels made even more money, right? And so think about investing in infrastructure and natural resources as the shovel to railroads. And so it's the shovel, or it's the thing that's absolutely, with AI, you got to have energy. You got to have data centers. You're going to have these things first in order for AI to be what it's going to be. And so remember, they're not chasing hype. They own the systems that keep the world running. And that's where we should be figuring out how to incorporate some of that into our investment portfolio. So if you learned a little something today, you thought it was useful, share this episode with a friend. Also, like, comment, and subscribe on YouTube or Spotify or Apple, wherever you like to get your podcasts. Remember, don't just hustle for your money. Make your money own the roads, the towers, and the resources that everyone is paying to use. And that is what the wealthy do. See y'all next week. Bye.